Hi, everyone. I'm Gregory. Okay, Greg. There we go. Gregory Landua. That's me. With Regen Network. I'm going to do my best to moderate this esteemed panel. The intention here is to have a little bit of a respectful and yet spicy debate. My hope is to try to get straight to some of the potential controversies, although who knows, we may end up having quite shared ideas about things. We actually don't know. This hasn't been run through completely. So we'll be doing our best to give you all an authentic experience of the state of the conversation around tokenizing carbon and the industry that we're all trying to build together. So I think I'm going to let everyone, what I would like is for each of you to just give a very brief introduction to yourself and the current state of how carbon is being tokenized with your approach, right? And feel free to also maybe share some hints of how you'd like it to be working, not just how it is working. But we'll kind of keep it brief because the conversation, and Raph, I didn't get to brief you on this, but the conversation I really want us to be having together is around at what points in the chain of tokenization of carbon is there responsibility for the quality of the public good outcome that is being exchanged, and why is it at that particular point? So we can all kind of center the conversation in that direction, but let's start with how is it currently working with your approach? And Paul, let's start with you, and we'll just kind of go across, and then we'll bring it together and have that conversation.
Sounds good. Thanks, Gregory. My name is Paul Gambill. I'm the CEO and one of the co-founders at Nori. In my background's in software. I got into crypto in 2011, and then in 2015, I started wondering, how do you actually solve climate change? And so doing like kind of a, I guess, root cause analysis on it, it seemed to me like there just simply were not enough people who were removing CO2 from the atmosphere. And so Nori was founded in 2017. We're a carbon removal marketplace, and we're an end-to-end solution. So we work with people who are removing carbon. Today, that's farmers doing regenerative agriculture in the United States. And then we help them cheaply and easily and quickly get that quantified and then do an audit and verification on the carbon that was removed. I think the thing that probably sets Nori apart from everyone else is we have a fundamental philosophical belief that carbon should not be traded. And so the entire carbon offsets industry has been designed on the concept that carbon credits should be the tradable commodity asset that are used to facilitate price discovery so that we know what the price of carbon is or should be. But in practice, that means that you can get carbon credits trading over and over and over again, which doesn't actually reduce the amount of carbon in the air. It's just enriching middlemen. And so from like a root cause analysis, we look at it like we need to be creating incentives so that every new dollar spent results in net new carbon that's coming out of the air. And our model is to have really a two-asset system. So we have an NFT that we call the Nori removal ton, NRT. And that's 1 ton of CO2 that's been removed and sequestered and verified and all of that. And then that's sold to buyers, and then it's immediately retired. So the NFT is made non-transferable. That buyer's wallet now owns that carbon forever, and they're not allowed to resell it. But we do still want a tradable commodity asset, so we have another token, which is just a fungible ERC20 token, the Nori. And one Nori always purchases 1 ton of CO2. So the Nori price will fluctuate based on supply and demand, and you can think of it sort of like a gift card that can be used to pay for a ton of CO2. If you are a company that wants to offset 100,000 tons every year, you could buy 300,000 of these, lock in the price that you've paid, just like a power purchase agreement works, and then use them over the subsequent 3 years. So that's Nori's tokenization models and to answer your question, Gregory, like we believe carbon should not be traded, and a two-asset model works better to incentivize more carbon removal.
Cool, thank you, Paul. My name is Raphaël Haupt. I'm one of the co-founders at Toucan and currently the CEO. We at Toucan have a slightly different approach. So we I spent 2 years kind of in deep research, kind of looking at the market, trying to kind of crack it open, like where do we, like, what is the leverage point? And ultimately, we took a very pragmatic approach to work with the existing supply that is, already out there. So we chose to go with Vera, which is the biggest carbon standard currently in the world, and figure out how can we make sure that the carbon credits in Vera can move on-chain in a deterministic fashion. So what I mean by that is that the asset, which is the carbon credit itself, actually moves on-chain. So the blockchain becomes the single source of truth of what is the state of this asset. And so unfortunately, there was no way to currently do that with the system that Vera has, because there's only two functions. You can either transfer a credit or you can retire it. But what we needed is some kind of new state, of like a tokenized state that would allow to like freeze an asset on the registry to then like represent it on chain. So in the tokenization process that we created, we asked the user that holds the carbon credit to retire it in the legacy registry, the Vera registry, and then make it reappear on the blockchain, essentially as a token. And we actually have, there's multiple tokens in our system as well. So we have what we call the TCO2 token, which is essentially a digital twin of the carbon credit with all the attributes, where does it come from, which standard, which methodologies are being used, etc. So that's a very, I would say, non-fungible asset. And then we have a different system which we call carbon pools, which allow to bundle these credits together, to put them into a smart contract. And on the other side comes out a single token, which is a more commoditized form of that credit. And I think the most well-known, probably here everyone knows that we've been, the infrastructure which has been bringing on-chain, like I think it's over 20 million credits at this point, and working with KlimaDAO to help them launch a pool, the base carbon pool, which essentially was the first treasury asset within the KlimaDAO treasury. And I'm sure like Marcus can tell a bit more about like the theory of change behind that. So where we are right now. So right now, I think we are at a very interesting point where I don't think that we would be sitting here, or at least a year ago, I didn't expect us to be sitting here and talking about this, because this space has gained a lot of momentum very, very quickly. And when we were working on this last summer, I do think that we're very much still looking at this as like as an experiment, and like how can we try to like use the tools that we have in Web3, how can we use decentralized exchanges, etc., to bring more liquidity and price transparency to this market. And we're now at an interesting point where we finally have the attention and the conversations with the standard bodies, etc., to actually build more integrated systems. And I hope that right now the Web3 carbon market and then like traditional carbon markets are still quite far from each other. But I hope that there's multiple working groups happening right now with Gold Standard, with Vera, etc., that are trying to find a more integrated approach to bring carbon on chain. So right now the Toucan bridge is stopped, so there's no new credits being tokenized on Toucan. And we're working closely with everyone to figure out how can we do that in like a very integrated way.
Hi, I'm Peter Rossberg. My background is I spent about 30 years in the Silicon Valley startup scene, so I have some great stories if anybody wants to catch me later to find about everybody from pets.com to everybody. Anyway, so I've been at Ripple for 4 years. I recently moved into heading up the product strategy for carbon markets. And what that means is I'm trying to figure out how we solve this problem of tokenizing and bringing carbon credits on chain. So one of the things that I'm really struggling with is the main buyer for these voluntary credits are corporates, and what do the corporates want? And they've gone beyond this check the box, I'm going to buy a carbon credit. They're really interested in like some of the UN, Sustainable Development Goals, so they're looking at like what other co-benefits are they getting from buying this? They want to tell a story about how they're funding a project and why. So that's one thing that I'm looking at, and I think our existing system of, more fungible tokens or a little bit of data about the project isn't quite cutting it, we need to be able to have really advanced searching technologies that we can say, okay, I want to get this vintage in this country with these SDG goals, and then have it pop up in less than 5 minutes while it's going on to distributed systems and trying to find the data. And then the other thing that I'm trying to figure out the solution to is forward purchases. So I want to be able to fund a project's development of bringing carbon credits into the market. One way I can do that, I can say, hey, I'll buy $1 million of your credits, and I expect those credits to be online 5 years from now. So how do I tokenize that forward purchase and do it in a way that doesn't get me in trouble with the government? And at Ripple, we know a lot about being sued by governmental organizations. And so you can't sell a forward purchase after you've bought it without it turning into a commodity. So how can we provide the guidance and tools for people that really want to fund these projects and not have them sued by the CFTC?
Without it turning into a future.
Without it turning into a future, exactly.
Which is not a spot commodity, which is a completely different animal. Yeah. Cool.
Exactly.
Thanks, Peter. Hi, everyone. I'm Marcus. I'm a core contributor at KlimaDAO. My background is in philosophy and physics, but I started working in data science about 10 years ago, and I'm really excited to bring that data-driven skill set to the sustainability and blockchain space. At Klima, we're not directly tokenizing carbon ourselves, but we're working with great organizations like Toucan that are bringing the carbon on-chain and trying to build both liquidity so that people can access these credits that have been brought on-chain with minimal slippage and transaction fees, as well as building a suite of tools and products that makes it really easy to source and retire carbon offsets in a verifiable manner. So one of the things that we haven't spent a lot of time talking about yet is some of the problems that exist in the traditional carbon market, where when you make a claim that you have offset using an organization like Vera, you would get like a PDF certificate as the proof of your offsetting activity, and we want to build a much more robust and transparent set of tools, so that when you make an offsetting claim, you can sort of show that off and share that. Because ultimately, where does the value of these credits come from is a sort of social consensus among the consumers of the credits that they've been produced in a verifiable manner. And it's really important that on the demand side, people are transparent about what type of credits they're consuming. And on the supply side, that we have high integrity standards like Vera that can attest to the integrity of the projects. Now, Vera has some issues historically that they've tried to address. And as Rafa said, initially the idea is to sort of build on the shoulders of those existing giants. But I think there's a lot of opportunity to bring innovation from the blockchain space to this important environmental market.
Okay, so I'm going to summarize really quickly, and then I have like 3 or 4 spicy questions that may be different than the one that I was starting out with. So, okay, so we have a situation in which there are both attempts and examples of tokenizing existing carbon credits. We have examples of tokenizing new types of carbon credits that represent unique claims, which also Regen Network does. And we have innovation to try to research what's sort of optimal in the situation taking place on the spectrum. So I have a spicy question for Klima, for Marcus, which is about what's the right, and let's keep it brief because I don't want to go super deep in this, but maybe we just like pin it up and say this is a conversation we need to have, but maybe we don't have it yet. What is the relationship between BCT as an asset and the value of the treasury of Klima and the model of trying to float a reserve currency as the driver for things? And is there a tension between sweeping the floor and choosing sort of like a lowest common denominator approach and having a defensible treasury value?
Interesting. So there's a couple layers to this question. So one aspect that I think wasn't totally clear when Klima launched is that it was never intended to be one asset to rule them all. right? The base carbon ton was supposed to be a starting
Except
point.
for Klima.
And I want to get to that, right? And sort of what is the role of Klima in this ecosystem? Why do we need a reserve currency that's backed by carbon? And as when you only have one asset like the base carbon ton, the liquidity pairs are fairly straightforward, right? You can pair that with USDC or your stable coin of choice. But what happens as you add more different types of carbon credit, different pools, like the NCT pool that launched several months later. Moss also has a tokenized credit that we've incorporated into our treasury. The number of pairs that you have to have explodes combinatorially as you add more pools, and especially if you want to provide the ability to enter and exit this market through different sort of source tokens. So, for instance, if you wanted to trade your Ethereum for a carbon credit, you would need a route from ETH to the carbon credit of choice. And so the idea behind Klima as a reserve currency is to put Klima in the center of those liquidity pairs, such that if you want to enter and exit the carbon markets, you sort of route through Klima. So that way, if you're putting USDC as your input, or Matic, or ETH, you only need to have one pair between that source token, Klima, and then Klima with the carbon.
So now I want to sort of shift gears and ask Paul a question. I love what you guys are doing, and after all of these years, I still personally really don't understand the distinction between a coupon that is a voucher for a carbon credit and a carbon credit itself. What is the difference? And in a way, it's like, what is really the fundamental difference between the unit and the floating token, and why is that important for all of us to understand?
Yeah, it goes back to the thing I said in the beginning, which is if we're going to be really serious about aggressively removing as much carbon from the atmosphere as quickly as we possibly can, then we need to be redesigning our whole carbon systems so that every new dollar or unit of money spent results in net new carbon coming out of the air. So when you have, like, the way this stuff evolved was in the late 1990s, clean development mechanisms developed, and there were frameworks put in place so that people could develop carbon trading markets. And the designers of these markets wanted a tradable commodity asset because that is how the economies of everything operate. So we need that in order to facilitate price discovery. But when you have carbon credits that can be sold and then resold, so you have a project developer who's doing the actual carbon project, setting aside whether or not that's actually a good carbon project, assume it is, then they sell that credit typically to a broker. And then often those brokers will sell it on to someone else and someone else and someone else. And so of all of the carbon credits that are ever created and issued, very, very few of them actually end up being retired. And so retirement is a carbon market term, meaning that it's consumed. It's the end buyer is saying, I own this now. It's no longer going to be available for resale. And so you get this weird situation where when you look at the total amount of like trading volume, how much money are people spending on carbon credits, the secondary market of the resale of carbon credits is significantly larger than the primary sale. And so from Nori's perspective, going back to this like root cause analysis, like there's no demand side liquidity problem. Like the demand is like nearly limitless at this point, especially if you consider all of the net zero commitments that big corporations are making. The problem is that there are not enough people removing carbon, and so we need to be creating our system so that the incentives are driving towards those people. Like if you have a carbon credit that is created and then resold 6 times over, you're looking at less than 10% of that total amount of money spent going to the actual project developer. So in our case, to answer your question, the reason that we do that is just to say that if anyone's going to be buying carbon credits that are coming out of Nori, that money is going to the project developer, the suppliers as we call them. There's no loss of efficiency there.
Gregory.
I got a counterpoint.
What's the difference between trading, like, essentially NCT, right? NCT is Nature Carbon Ton. It's a coupon that lets you redeem any of the underlying nature-based carbon credits in the pool. What's the difference between, like, trading like Nori, right, and all the, like, if the price of the Nori token increases, like, what's the difference between like trading the coupon and, like, I would argue that if I buy Nori today to, like, because I think that it's going to increase in price, and I sell it like 2 years later and I made a profit, none of that money really initially goes to project developers. So what's the difference between like trading the essentially commoditized form of it, which is the Nori token, because it lets you redeem any of the underlying?
Yeah, it's because of the claims that companies make. So if you're a company and you're making a net zero commitment and you go out and you buy a bunch of Nori and then you don't use them, to redeem for carbon, and so later on you sell them and you make a profit on that, you cannot possibly make a claim that you offset any carbon.
But the same is true. Wait. But the same is true if you go buy a bunch of BCT, NCT, Region Eco credits, or just Vera credits. You don't make the claim until you issue the retirement, and you have a certificate of retirement in any of the systems.
The difference is, though, that historically there have been many cases of companies that buy carbon credits and then don't retire them, make some sort of claims about them because layman journalists are not familiar enough with this, and then they can resell those carbon credits at a later date. They sit as an asset on their balance sheet.
But that's not a problem with the asset.
So I want to do two things. So I don't actually think that that answers the question, but I actually want to take a crack at answering it for you.
By all means.
I think so. I mean, there's a set of principles here which we probably all agree with, which is that we want people to only be able to have make claims when there's a transparent record that they're the ones who are responsible for funding the change that's taking place, the carbon removal. Awesome. We want a system in which there are incentives directly to the land steward or the remover or avoider of the emissions in question. There's another whole debate to have there probably. Okay, great. How do we design that? I can see the case for kind of a simple UX story for a farmer to be, or a project developer, to be developing the Nori removal ton NFT and holding it as they're watching the floating price and not choosing to allow people to retire it and therefore having an upside in a moving market. And I think that is, I just want to disclaim, I think that's completely possible with other approaches, but I think it's an elegant UX experience.
That's actually happened. We've had farmers who, as they've been going through the enrollment process with us, see all of that kind of hype around soil carbon and the value going up, and they say, can we go through enrollment, quantify, but then not sell it because we think it'll be worth more in the future. But on the other side, again, from the UX perspective, the buyers of these credits, they want to feel like the money that they're spending is making impact. And so they want to buy more recent vintage carbon. They don't want to buy carbon from offsets from 5, 10, 20 years ago.
So they got to pay more money.
Well, in this case, though, it's trying to suit that balance of how do you give the project developers the potential price upside while also delivering real-time value to the buy side. And so that's a solution that our 2-asset model actually provides, in addition to insurance, which is a whole other thing too.
Okay, so I also want to get into the. I think just sort of putting a pin in where it is an industry, where are there really substantive conversations to have, not necessarily to get deeply into it, but so I think there's a pin to put into different types of credits that may need different price discovery mechanism, may actually be different commodities. Carbon removal versus avoided emissions, for instance. And maybe this gets into like the appropriate pooling or basketing or the challenge of fungibility. What is fungible? What is not fungible? How do we commodify and allow the market to engage with that? So, Marcus, it looks like you've got some things to say, and I want to hear Peter. I want to hear Peter.
Yeah, so
I've got a controversial thing.
I typically frame this in terms of a trade-off between fungibility and liquidity, right? So obviously, the more specific you are, right, about this particular vintage of this particular methodology in this location, the number of credits that exist with those specific properties is small, the more specific you get. And so that's where the pooling concept allows you to strike this balance. Now, at the beginning, beginning, the pools that were launched, like BCT, focused on the current state of the market in the traditional world, which is mostly large-scale renewable energy projects, as well as nature-based avoidance, which is where NCT ended up launching. But the way we look at this is that over time, as the market matures and new methodologies scale up, such as cook stove conversion or mangrove restoration, that you would create additional pools that model those new segments of the market over time.
So new commodities are created essentially, and in this process, the stand-in for a commodity is a pool which has some challenges like lowest common denominator, arbitrage issues, and some other things, but that's the proxy for sort of like the fully fungible commoditized unit. Okay, Peter.
Yeah, so Ripple has a $50 million fund that is specifically to trade, not to retire. Now, we have another group that is just buying and retiring to get us to carbon neutral by 2028. So why do we have a $50 million fund that's just to trade, other than maybe we're an evil corporation? It's actually because we believe these forward purchases help get commodities into the market sooner, right? So
totally.
I've got a forestry project. I've got a cook stove buddy. He's like, Peter, if you can just give me $1 million in purchases, I'll have that stuff online for you in a year. And so we're buying these credits with the intent of them being delivered to us we're really looking at like a 3 to 5 year time frame. And that gives that producer the ability to generate that stuff. We get it 3 to 5 years, and we're planning on flipping that because we're figuring out we're getting a discount for buying it. We're doing the calculations to figure out whether it's going to go up or down. Direct air capture is kind of complicated because it's $1,000 now. It'll be $250 in 5 years. But then we don't want to be totally evil, so we do have a profit sharing for reselling those. So I think there is an argument for traders, as long as they're doing that kind of trading, where that's just an alternate funding model where you get that money sooner. It's almost like factoring your receivables or a loan to the company so that they can actually produce sooner.
I'm not at all opposed to speculative trading. I just don't think it should be done on the carbon itself. That's all. But
again, is it the voucher, or is it the carbon, is it the pool?
It's the same thing. It's like you could argue that it kind of is, right? Because like you could argue that because you have Nori is one token that, so you're basically treating every carbon unit the same, right? Is that still the case, or
that's actually that's a longer conversation, because the way that
all roads lead to the way that Region is doing things. You'll see.
Subtle shift.
I think our moderator is biased.
I don't know what exactly you guys are doing with respect to this, but I will say from my personal perspective, like the market has placed a value on permanence. Permanence meaning how long is the carbon coming out or being avoided. Personally, I don't think permanence matters, because we have a carbon
at all, or just as much as people say it does.
It's just as much as people say it does. Okay. It does matter a little bit, but we have a carbon problem today, not just in 100 years. And so what really matters is throughput. How much carbon can we possibly pull out today, tomorrow, next year, and so on?
So there's a cycle. So you're sort of like, there's a cycle, there's emissions flowing, and there's reductions flowing. And what we need to do is change that flow.
That's right.
Year on year on year on year, from now until the future, and it isn't so much important.
Forever.
Yeah, exactly.
As a species, it is our responsibility to manage the carbon cycle from now on.
So is there a role for like a carbon ton year?
Yes.
Do we? So the evolution of this may be sort of a quantity and a time.
That's right.
Instead of sort of like people fighting over the commodity of we want to, the features of permanence and additionality and other things, and trying to make a universal standard of that, we may be creating more of a time and, like a time unit.
Yeah, exactly. And again, historically, the reason that this is even an issue is because when offset markets were developed, if the average life cycle of a CO2 molecule in the atmosphere is 100 years, and you are a company buying avoidance credits, you want to make sure to be, roughly equivalent that the amount of carbon being avoided is being avoided for 100 years. And so that's why 100 years has just become that sort of arbitrary default standard that offset registries apply. But it doesn't really make any sense, because how many 100-year-old companies can you name today? And so if you're asking like a forest manager to ensure that they're going to keep that carbon out of the air for 100 years, it is incredibly unlikely that they're going to continue doing that. It gets even worse, actually, if you look at like practically how it works, because they'll estimate out the total amount of carbon that would be sequestered over 100 years. They'll collapse that down to 20 years worth of vintage credits that they issue over the years 1 through 20. And so you're, as a forest manager, you're getting income over that time. But then in years 21 through 100, you have no operating income from the forest. How likely is it that that forest is still going to be there at the end of 100 years? So we have to introduce some sort of ton-year concept. And at Nori, we've relied a lot upon the work that NCX has done in this space. It's pretty advanced.
Cool. Thank you. I think that's useful. Comments about, I think now we're getting into maybe there's sort of like what does carbon tokenization look like optimally for markets like
I can maybe just like, because this 10-year thing is, I think, super relevant for when we talk about carbon removal, right? Because like permanence is the big like problem with carbon removals. Like how long is it going to stay there? Additionality is the biggest problem for avoidance, right? So I do think like it is really important that we treat those two things separately because they have a very, very distinct set of problems.
Those have to be two different commodities, essentially.
Absolutely. I think like it's two different things. Policymakers should treat them like as two different things, two different strategies, etc. Because it's just not the same thing. Just like which is why I was kind of like trying to understand the role of the Nori token in that concept.
Which is a removal voucher.
We only do removal.
We only do removal. Yeah. But you're treating then all removal the same. Is that...
Well, right now we only have one methodology, which is for ag. And so in that case, all of these soil carbon NRTs are the same, and they have 10 ton years associated with them. And so our intent is when we have something like direct air capture being sold, then there would be some way to determine what is that level of permanence, and then issue a quantity of NRTs equivalent to a discount rate. So say you decide it's 100 years from DAC to mineralization, and then apply some discount factor on it too. So maybe they get 7 NRTs for every 1 ton. These are hypothetical numbers, but that's how you'll deal.
So you won't. So you're not trying to create like a standard removal unit so much as you'll address differences in permanence through an increase in the cost of the number of vouchers.
Well, Nori becomes a 10-year removal ton.
Nori will always be a 10-year unit.
Correct. Yeah, that's right. Okay.
And you'd issue fewer of them if the project had less, like if it had 7 years.
So I was going to say one thing on permanence. A lot of that has to do with corporations buying something and then assessing the risk of buying it, the reputational risk, right? So I just paid for this forest and 5 years later it burns down. Or in some cases I paid for the forest and then found out that it actually burned down, but it was still in the registry as a valid forest. That happened in California. So one of the things we're looking at is just the other SDG goals, the co-benefits for that. So I may invest in a rainforest project. Maybe I've got some co-benefits, helping the local community, biodiversity. So worst case, it's not preserved. I still feel like as a corporation, my reputation risk is minimized because, I did all these other 5 things.
Well, so the example there might be that you're protecting a forest, and if something happens in which the forest burns down, there is actually a fund, a reforestation and erosion control fund or something that accelerates the replanting as part of the project or something.
That would be more
which is often the case.
Which is like buffer pools.
You use a buffer pool, and there needs to be sort of like capital to sort of like interact with that force majeure that just took place.
But this is beyond the buffer pool. I mean, assume the buffer pool's there, but let's say it doesn't cover it enough, or you still have this reputational risk of the public doesn't care, your forest burnt down, right? And maybe it was covered with other stuff. But having those other SDG goals attached to it allows you to say, well, look, that was a problem, but we also had these 5 other things that we actually did do good and contribute to the community, so that keeps the value of the
so now we're getting into the place where my original question is pertinent, right? Which is where in the process of the creation of these digital assets which we talk about in terms of tokenization, is responsibility for legitimacy, integrity, and then there's different dimensions which we've been discussing. Which additionality is paramount for avoided emissions. Permanence is paramount for reduction. Co-benefits, it seems to be an emerging quality that is paramount for many buyers, corporate buyers. But who bears the responsibility? Is the marketplace bearing the responsibility? Is it the project developer who bears the responsibility? Is it a registry that bears the responsibility? Is it everyone? Is it everybody and nobody? Who bears the responsibility in the tokenization and origination pipeline?
I'm happy to jump in first here. One of the things I think it's important to learn from the legacy market, from the traditional offset market, is that there is a market structure that they've come up with that has developed over years where multiple parties are involved in the origination and issuance process. The registries play a really important role in setting standards, sort of baseline standards. I don't think that there's any world in which we can do away with that trusted standard aspect. But I don't think that the registry alone should be responsible for this. I think it's really important that we have third-party auditors like the VVPs in the traditional system that ensure that the projects that implement those standard methodologies accepted by the registries.
So those are two different things. So there's a group of organizations who are agreeing that an approach is the best approach that's available. And then there's an organization who has the responsibility to ensure that a particular project is following said approach. So there's sort of there's a separation.
And you're
there's
asking
two
about the
different
former
pieces.
question?
Can I just, it's three, because there's the registry itself, right? Because like you use registry and standard as the same thing, which is like one thing that I don't understand is like the role of a standard is to essentially have a governance process and appoint VVBs, to go check on these projects. But it's not the same thing as running a tech platform that keeps track of
Which registers an asset.
Which registers an asset and just keeps track of it, right? So that's, I think, a very important distinction.
So is the registry, I think right now registry is sort of a catch-all phrase that's used to describe a bundle of different features, which include social legitimacy processes, peer review processes, and the technology needed to track who currently has the rights to exercise a credit offset claim, right?
Well, here's the thing about the registries. One, I've actually, you guys have used the language. These are Vera is the most well-respected one out there. Vera has approved thousands, hundreds of thousands, if not millions, of junk carbon credits that had no impact on the amount of carbon in the atmosphere. The only reason that they're viewed in this way is because they've been around longer than everyone else. They have no divine right to be the only guarantor of certification.
I fully agree with that.
The other thing is good. The other thing is that these advanced market commitments that Peter was referencing, they're moving beyond the registries. The registries are becoming less and less relevant every day because they cannot possibly keep up with the demands that are coming from the corporate world. So when you're looking at $925 million from the Frontier Climate Group, not a single one of those is going to projects that are going to have Vera certification. So I sort of wonder, this is something I've been speculating about recently. At what point do we just move on from those registries? And it's not just moving on from the concept of certification, because that will happen, but it seems like it's decentralizing in a way where buyers are no longer going to care so much that it was a specific stamp of approval from Gold Standard or Vera, and more on doing evaluation and diligence on the certification, different certifications that are happening. At Nori, we consider ourselves a registry in that way. Yep. And so,
and also there's an interesting function that I've been noticing in which it seems like corporate buyers have evolved so that they're no longer a Vera or gold standard credit is no longer enough. They're looking at B0 or Silvera or other third-party audits, and then they're choosing from those. And so there's a trust migration taking place.
And that has trade-offs up and down too, because like Microsoft can put out an RFP for projects, but it's 35 pages long, and you know this well because you sold to them from Regen, and so that's like a difficult.
It was a long process. For
that's
sure.
a very, very difficult process to go through, and so that's also, in my opinion, not very scalable. And so only the biggest companies who care most about the legitimacy of things are the ones putting in that sort of effort. And so again, I think we need different models if we want to scale this.
Microsoft had more people staffed for their carbon RFP program, I think, than maybe Vera has on their whole organization.
I believe that's right. Yeah.
Well, the point I wanted to get at. Sorry,
okay.
Peter.
I'd like to just say, so I think there's space for registries. I think there's space for, verification bodies. But the more expensive the credit is, the more techy the credit is, more new the credit is. There's just nobody out there that can even verify, right? Vera's, we talk to companies that are like, well, we're in the process of getting our methodology approved by Vera, but there's no methodology for, bacteria eating methane and shitting out plastic, and so it's going to take them 3 more years to figure that out. And so I think there's got to be a way for some projects, we're looking at letting them self-certify. Or some projects, again, going back to the SDG goals, are they're going to have 3 or 4 different verification bodies that are they're asserting claims against and they're getting verified by. And so our opinion is, look, we provide the way for you to register your credit and then to assert as many claims against it as you want. And some of those claims may be, I'm just claiming that I'm doing a good job and you can audit me yourself. And I think that's fine.
Can I bring it back to your question, which is like, what's the role and responsibility? Yeah, so I think because of that situation, it is actually the responsibility of the protocol developer, whoever is like putting together these methodologies for measurement and verification, to have the highest standards that you can possibly afford to have, because it's not. No one else is going to come in and take care of that for you. And I also think that that's very much related to the concept of insurance too, which we kind of glossed over a little bit.
There's another pin. A socialization of risk associated with claims, the role of buffer pools, the role of creating financial instruments around buffer pools and risk, I think is a really and I know that there are people in the space who are sort of like maybe in stealth doing things to try to solve that. But I think that's a really important piece. And in some level, I think it's probably better built in public, right?
Absolutely. Yeah, the point I wanted to get at by bringing up the market structure and sort of laying out the relationship between the registries and the standards and the VVBs is that there is an inherent concern about conflict of interest in these markets, because if you are doing the standard methodology development and you're running the registry database and you're verifying your own project or choosing the partner who's going to verify your project, even if there is no actual conflict of interest, the perception of a conflict of interest will undermine the commitment of buyers to trust that. And so I really think it's important that we learn that aspect of separation of concerns from the legacy market, and maybe there is an opportunity to further subdivide and create more clear distinctions between the standards bodies that generate the methodologies and the registries that run the underlying database.
Because Paul, right, like I fully agree with what you say. Right, we see like Vera is becoming a bottleneck. Like there's so many projects that like want to get certified, it can't get certified, it takes years. So we are at an inflection point and we're going to see a lot of new methodologies being developed, and we need to make sense of the world, right? And what I care about with Toucan is that we have a common language to talk about carbon on chain, preferably because I believe that carbon assets are best to live on chain because they're intangible assets. They're just a bunch of data and stamps, and we need this like interoperable layer that we can communicate and we can transact. I believe in that, and so I think we need a world where Vera, Nori, Regen, Open Force Protocol, and all the others can like have their tokens, have their credits, transact on the same platform, on the same, like a same ledger, essentially. And I don't believe that we are. I don't believe that we're doing different things. We're just at different, areas of the spectrum, right? And I do, for instance, I do believe that the work that you do, and the work that you do is super important. And I do think that like getting farmers to transition to regenerative agriculture and like financing that transition is really important. And I would love to have the possibility to have the nori removal tons transact like in the same system than the token tokens, as well as we're building a bridge to region ledger as well. So I do think it's more important to have that interoperability and to allow the decentralized kind of sense making and proliferation of ideas than trying to like create zones that are like that cannot talk to each other, right? Because we have trillions of dollars to move.
We'll integrate NRTs into anything as long as we can ensure that they're immediately retired. That's our main requirement.
So what you'd want to see traded would be the nori token.
That's right.
Right, and that's what would be integrated, and then the retirement process would be like claiming that NRT under it.
Yeah.
I want to tie this back to your original question, because I think the answer is that each party, each market participant has a role to play in this question of quality or impact. Because on one hand, if the buyers are not interested in, say, NRT, or they're not interested in, XYZ avoidance ton, then the project developers are sort of going to receive that market signal and see that there's no buyers for the credits they're producing, and maybe switch methodologies or find a new career path. But the important point is that each issuer of the credit needs to have a transparent and public documentation and accounting of how they're doing it, so that the market can then assess those the relative merits of each approach.
I agree.
I think it's time to start wrapping it up. So, luckily, we are going to get to spend time, everyone who's interested, in having a deeper dive conversation that is more inclusive of the larger audience here shortly. So Mark will tell us when and where, and so that's where. So if you have follow-up questions, if you have comments, if you're energized or concerned by the conversation, we'll get a chance to start to dig into that together a little bit later.